confirmation here that you do see me or hear me and see my screen, I should say. Okay, thanks. Oh no, that's already an old message. Excuse me. I still need that confirmation just quickly. If someone could just type a Y, then we'll get the show on the road. Thanks, George. Great. Thank you. Perfect. Alrighty. Thanks for being here. I always love having these great trading presentations, I hope. And I'm looking for loud and clear. Great. I'm looking forward to today's topic because it's one of my favorite. Oh, I have a spelling mistake here, I see. There should be no end there. Classical trading, the jigsaw puzzle. I truly love technical analysis. So I think that this webinar will be a good guide for you to see how you can kind of piece together all the tools. I know that most traders, of course, signal or focus on maybe one or two items, two tools, I should say, which is fine as well, by the way. You could do great stuff just with trend lines and a fib, or only trend lines, or only price action. But what I do like is that if you have all these tools available and you know a bit of, everyone knows a bit of everything, how about if you put it all together? It does, of course, get a bit more complex, but maybe there's also some advantages. And I want to show you how we can use all these tools and kind of piece them all together like a jigsaw. All right, so that's why we have this topic. But before we actually start, let me zoom this out. No, 1 second. Just give me 1 second, folks. I need to start the screen slide. How do I do that? That's weird. Sorry, folks. From beginning, start slide. It should, here. I need this monitor. All right, I don't know why it was giving me a headache. Let's get rolling. So welcome. This is Admiral Markets. My name is Chris Forsick, and I'll be your host today. All right. Admiral Markets, you can follow through Facebook, Twitter, and Google+. But before we start, just a quick risk disclaimer. Please be aware that trading foreign exchange is, of course, risky, and this is a educational video only. All right, this webinar is just for educational purposes. And please seek the advice of an independent financial advisor if need be. All right. So thank you for your attention on that. So as I said, today's event is sponsored by Admiral Markets. So I just want to inform you that there's a great contest with great prizes at forexball.com. If you were not aware of that, if you've been here more often, then you know that you can buy and sell directly from the NT4 platform, which is a unique feature of Admiral Markets. What I like about it is that you can also have the depth of the market, and you have great spreads. So please take a look at Admiral Markets to see if Admiral is a good broker for you. I would recommend them. All right. And something else also, by the way, not only good stuff like that, but they have these daily wave analysis, for example, and they have for fundamental technical analysis as well. But for those of you who know, I like Elliott Wave, so it's always here. You can get a good indication of what's going on. All right? Cool. So today's goal is going to be an explanation how you can use multiple tools for great trading. So it's just basically using our standard technical analysis tools, but all placing it together to get a great, it's like making this grand puzzle of 2,000 pieces, and we're going to be showing you, or I'm going to be showing you, how I place one piece at a time. All right? So today's agenda, explanation how and why discretionary technical analysis I think is the best for trading, how we're going to be incorporating multiple tools in one overview, how to read that on the charts, and some examples of the charts. Alrighty. So, just as you know, some questions before starting. Just curious, what tools you use in your trading? Do you use trend lines and fibs, for example? I'm just curious what kind of traders we have out there. We have a nice group today. So if you have a second, then that would be cool if you can drop a note. All right? Alrighty. Now, this is kind of my approach to Forex. So I basically use this module for every strategy I make, and some of you have already seen it actually before. I've used it once or twice to explain. I think we showed in February 2 of my strategies, and I'm glad that you guys like that. So basically, this is again a strategy in a way. So that's why I wanted to show you this. That we need specific goals that lead to the triangle of risk, money management, and trading strategy. And we're going to, of course, focus on technical analysis. That's why I have that green. All right. Now, the trading strategy, we're going to be basing it on technical analysis of the Forex chart. Of course, you know me. I love technical analysis. So we're going to be identifying areas of confluence to enhance the statistical probabilities of success. We're going to be using week and day charts for long-term analysis and 1- and 4-hour charts for entries and trade management. So, that's basically the goal, is to identify key levels on week and day charts, but then to zoom in and maximize our reward to risk in lower time frames. Alrighty, so the trading strategy goal is going to be trading impulses when there's a clear trend. I am definitely in favor of this type of trading. I'm not saying that ranges or corrective moves are bad to trade, but the problem is that I think that if most of us are retail traders, and I think that this should be our main task, because the thing is that if you're maybe a bank, you can have that flexibility of being in the market all the time because you're shifting money constantly back and forth. But as a retail trader, we really want to most of the time be kind of picky and choose the areas where we expect the currency to move the fastest to our target. All right. So if we expect the impulsive move, if we expect 200 pips within the day, that's kind of the best area we want to trade. We don't want to trade corrective parts that take 5 days to reach a 50 pip target, right? So that's definitely my goal. So we're going to be analyzing the charts case by case. It's going to be a discretionary trading. Of course, we're going to have some rules, but it's not going to be a mechanical trading style. So we're going to be judging if there is a trend and then whether the likelihood of an impulse is there. All right. So if that is, then we're going to be trading or trying to trade that currency, and then we're looking for confluences and then trying to capitalize on that swing, on those swings. So it's going to be a bit of a swing strategy, if you see what I mean. Not so much a intraday strategy. I'm myself a more swing trader, so I have some experience in intraday trading. So I showed you one strategy last month, but I'm more of a swing trader. Oh, I got an answer here. Garrett is using candlesticks, fibos, extensions, trend lines, pivots. Cool. I use them as well, except the pivots. I don't use pivot points. All right. And Atanasia is using price action setups only. Okay, cool. Price action is definitely a good thing to use, absolutely. So we're going to be identifying the likelihood of a trending impulsive move. That's the goal number 1. Then we're going to be, just to summarize, goal number 2, identifying areas of confluence and interest for high probability trending move continuations. And then the trading plan mechanism, for the entry, exit, trade management, the reward to risk, and preferably a time plan. Alrighty. So those are the steps, the process. Alrighty. So basically, I just want to emphasize again the corrective versus impulsive, non-trending versus trending, and trending impulses, why they have the most beneficial, or why they are the most beneficial. Number 1, it's great for the trading psychology. We had actually a webinar on fear last week. I hope you saw that, because trading psychology is really actually, I think, even more important. As you're probably aware of, many traders think that trading psychology is more important than actual trading strategies. So, that's key, I think, because if you trade that impulsive move, you're going to reach your target fast. You can move to break even faster. And this is all supporting the psychology. If the trade is moving in your way, it's just a lot more comfortable, and you'll be in that comfort zone a lot sooner. Correctives take longer, and you're going to be worrying a lot more about your trade, basically. It's good for risk management as well, because as soon as you hit your target, or if you've moved to break even, the risk is off the table, which means that you can risk new capital again on other opportunities. If your capital is stuck 5 days in a trade, then it's going to be difficult to take another trade. You might lose the opportunity to capitalize on a good trade setup. So those are good reasons to trade those trading impulses. This is just I don't want to make it too complicated, but just a quick scheme of the thought process of what you could use. For example, now I use some, like, for example, added wave. What I use, price action, candlesticks. You can make a flow chart as well, so that you can say, I want this and this. First, then I look for the confirmation of direction, then I use for a directional guideline, so that you can organize your plan and thoughts in this way. All right, just wanted to share that with you. Sorry. All right, so this method is going to be discretionary, as I said, and it does have some advantages versus strict rule-based strategies, because I believe that the currencies, our setups are unique. We have to analyze it like a detective, case to case. We're going to be analyzing the setups, weighing the importance of certain aspects, and most trades will not be perfect. There's always going to be some drawback, so it's going to be our decision to see if the currency is set up justly and well enough for us to risk our capital. This, in my opinion, gives us the flexibility to move along and go along with the flow of the market and be flexible enough. If you only trade like very strict mechanical, I think you either need huge IT power, which most of us don't have. I think you need a lot of strategies, because if you focus only on one mechanical rule-based strategy, it could work very well 1 year, but then the next year the stats could be totally different. That's because it's just actually at random, these strategies, in my opinion. They work well for 3 years, but then year 4 or 5, they give a negative result. So if you spread your risk over maybe 20 mechanical strategies, rule-based strategies, and 15 work and 5 don't, then at the end you got a positive result. But you need a huge trading capital, you need IT power, you need programming skills. It's not easy, and I'm sure you would do okay with that, and you get a pretty good return. But I don't think that it's not so doable for the average trader, in my opinion. I think it's in that regard we can increase our statistical edge by actually judging the likelihood of a trade materializing if we judge it ourselves. All right, but it does require discipline and patience. All right, so let's move on. Let's go onto the actual trading idea. So the first thing is the classical area we want to identify is the trend. So of course at one point the trend is ending, so I just have to start somewhere. So the trend is your friend until it bends, a well-known saying. So what are the classical indications of a trend bending? Number one, divergence, preferably on a higher time frame, a day chart, 4-hour chart, both, week chart even. Then we want a maybe pattern of, for example, a falling wedge, as we have on this example. For example, here we can see that the bottoms are becoming less distant from each other, but the tops are narrowing in, so that's a rising wedge. For example, it doesn't have to be like that. Then we normally typically see a break of the high, and we start to see opposite trend directions. So we see higher highs, higher lows in this case, because we had a downtrend. If we had an uptrend, then we would see lower lows and lower highs, of course. All right. Now, mind you that even if we have those higher highs and higher lows, we still want to be careful, because it doesn't mean that if this trend is over that we right away have a trend to the opposite side. We could see a prolonged consolidation area before either of the two happens. So that's something we definitely want to be careful of. So to get an idea when that happens, of course we might break a local high, but you always want to be very careful of a structural high and a bigger trend line, not only the immediate trend line. All right? So once we do get a turn and we do start moving to the opposite side, and we identify on a week or day chart maybe a huge fib where the currency could turn at, then, and we expect a trend to the opposite side, all right, then we can start doing the analysis of building the trend. Now, what we're basically doing is connecting the bottoms to see where the likelihood is of the next trend channel, all right? So if you have a new low, you can connect those points, connect it to the top, and that's where maybe this top will stop, and that's maybe where the third point will stop. All right? Now, it doesn't have to be exactly there. Trends and trend channels and trend lines are just areas. So if it doesn't stop exactly on this line, and if it actually shoots a bit through, or it actually is shy of this line, then there's nothing wrong with the trend channel where price action is a bit outside of that, or here, or there. You know, the channel doesn't have to be perfect, and all price action is within it. A overthrow, some price outside of it is fine. But what we do need for trend channel is definitely 3 hits. I like trend channels on 4-hour charts, but you can build them on day charts as well. You can even use them on week charts, but it's not so usable for us swing traders. That's more like for position traders. I think 4-hour chart is a very good chart in that regard because it has flexibility within the week. You kind of get 30 candles within 1 week, 6 within 1 day, so it does give some flexibility. A day candle is slow, you know, it's tedious, it takes long before you get new information. 4-hour works fast, relatively. So a bit of overthrow is no problem here, all right, as long as you have 3 hits. That's the #1 requirement, all right? The other thing you want to take a look at is, for example, is that at the beginning you have a trend channel like this, and at some point in time the channel is going to be broken to the upside by an impulsive move, because if it doesn't, then this smaller channel might still be a bear flag, and at one point maybe the currency breaks to the downside. This was just maybe a correction, and it continues to the downside. Why would you want to see the break of this upside channel? It's just to prove that actually we are indeed turning and that the trend is expanding to the upside. If it doesn't do that, then we still actually might see that break to the downside. All right? We always want to be careful about that. So if we do get that impulsive break, then we will be adjusting that trend channel. This initial line here will become the middle line of the bigger trend channel. This impulse will shift and push the trend channel. We will hook this top line to the new top. This original line here will become the middle line, and that middle line will remain important for the rest of the trend, because that middle line will be respected as well. Actually, even the quarter line here will also see respect. What I mean with respect, price will pause at those spots if your trend channel is correct. So those top, upper lines are of course very key, but also the middle line and even the quarter lines are important. Yes, this webinar will be available. It should be available. It normally is recorded, so you can go through the material one more time and pause it, I guess, if you want. No problem. So this is an established trend. You see I drew the quarter lines and the middle hard line and the top and lower line. So you have an indication of how, you know, a theoretical example of a trend. We have 3 hits, and we have impulse move. You can see first quarter line, hard line. It's respected here, here, here. You can see the middle line is respected, etc., etc. This is just a theoretical example. I'm going to go into a chart very fast. One thing we should note, though, is the angle of the trend. I just want to quickly say this because it's important. The angle is important. Why? Because if the angle is too shallow, it's not a trend. The power of the market is too weak, or actually the correction, the up move is too weak if we're in an uptrend. If the angle is less than 45 degrees, no, less than 30 degrees, excuse me, if it's too shallow. 45 degrees is ideal, and if it's higher than 45 degrees, it's too steep. Now the rationale, the psychology behind it is that if it's too slanted, if the trend here is too weak, it doesn't have a good slope, then there's just not enough power in the market to the upside to move this channel to the upside, and we'll probably see a break to the downside. If it's too steep, it's not sustainable. The price has to correct this steepness, and it will make a correction to the downside. A 45-degree angle is just basically indicating, or 30-degree angle, indicating a balance between time and price, so that it's sustainable. That's all. It's a sustainable balance. Now 30 degrees is also fine in my opinion, but anywhere in there is fine, but there's a statistical probability that if it's higher or lower, that it's just not a good relationship between time and price, and the trend is just not a sustainable, nice trending mode. Very important. All right, let me quickly show you now that example of a trending chart. For example, this euro dollar on the day chart. Now you can see here the upper and lower lines, and we'll just quickly add the middle line here, which I'll make a different color. Let me make it orange, I guess. Doesn't really matter. All right, somewhere like there. And I would like to go to a 4-hour chart now. I just have to find, where is it? One second, folks. That's weird. August. I can't reach it on a 4-hour chart, I guess. All right, doesn't matter. In any case, you can see that what happens is that at first we got a break of this up move, right? This correction to the upside. We get a break here. We don't get an immediate continuation. We get some consolidation here, like a descending wedge, as you can see. And after that break, we get an impulsive move, which for you added wavers is the wave 3. And after that, we get a correction. And you can see that if you use this added wave theory, where you connect the wave 1 and wave 3 and hook it to wave 2, that's exactly where the wave 4 ends. This is a very neat channel to the downside. It doesn't have 3 hits, but it's a day channel. I like to have 4 hits, 3 hits on the 4-hour chart. As I said, 3 hits is key. But I would like to see it on the 4-hour chart. Doesn't matter. I can't see it there. I'll show you a different example on the 4-hour chart. But now I'm there. This is the 4-hour chart. All right, cool. Alrighty. So at first you could, for example, use this as a channel, but this angle is too weak. And you can see that eventually we break that channel to the downside with that impulsive move. Remember I was talking about that? So you could even do something like this. It's subjective. That's a big, big trend. I don't like that much, because you can see that this channel is a lot better. But still, you get the point. So let's move on to another example. So eventually, we have this downtrend. We get divergence here between the bottoms. Let's start from the beginning. We get a break of this kind of falling wedge in a way. Does everyone see that here, like this? We get a falling wedge type formation. We get a divergence, multiple divergences here between the bottoms, between this one. We get a falling wedge. We get a break of the falling wedge. We get 5 waves up, for those of you who like Elliott wave. So that's first heads up that we might be going up. So we're still in this bigger channel, of course. But then we get a break of that bigger channel, and we get price action outside of that break, and then we might be turning gears. All right, so then we can already establish, once we get this point here, we can already start building the new trend channel, and we can connect that, put the trend to this top. All right, so we get the falling wedge, we get the divergence, we get the 5 waves, we get the next break of the trend, we get a hook back to the trend and bounce. We get a third hit of this new trend channel. Does everyone see that? Exactly to the pip. Beauty here. Great stuff. And then we keep on going in that trend channel. And eventually we do get the impulsive side break. All right? So that's a great trend. And then we can expand it to here. We can put a hard line like this. Something like that. Somewhere in here. You can see that the hard line is nicely respected. Right there we paused, here we paused, here we paused, here we paused, just shy here, etc. So we continue. We get a bit of a move down. So maybe we're changing gears here. You can see that the uptrend is over. We didn't have divergence though between this top. That's why the likelihood of a continuation was still high, because this momentum was high, it's strong. But we still have to follow price action, and we can start putting a trend like this at first and like this to see if this is going to be a continuation or not. Okay, we get the first break here, and the second break we get here. And we can see that we're going to get a continuation, so we can adjust the trend, something like this, and the hard line as well. The angle of the trend is adjusting itself. Something like that. All right. We need 3 hits, which we do have. We have 4 hits now. Actually, you can even maybe do something like that. All right. So we incorporate this one, this hit, and this hit. All right. We got multiple hits here. This was an overthrow that happens in the currency market. Let me adjust the hard line again, like that. All right. So we're back in the uptrend. Perfect hit here and here. Up we go to the top of the channel. All right. We respect the hard line again here. Oh, excuse me, I moved that. We break this uptrend, hook back to it, and down we go in this downtrend, as we know in the euro dollar. We can put a downtrend line, and we're still underneath that downtrend line. Alrighty, so that's just classical technical analysis using trend channels to give you a good indication on the 4-hour chart what you can see in real life as well. This is just a great example of a 4-hour trend there on the euro dollar. All right, so I love that stuff because it gives me an idea when I'm in this zone here. For example, when you're in the bottom quarter line, those are great buying areas. Even, for example, if you're in this area and you get a retracement like this, for example, those are still good buying areas because you have a lot of space to the top of the trend line. Now, you want to be, of course, very careful when the currency gets to this top quarter line, because that's actually a place you want to take profit. The currency could make a stall like this and go back to this hard line, all right, middle line. One statistic you should know is that in a trend, there's an 80% chance of the middle line being hit. So if you're below the middle line, there's a good probability that you're going up to that line again. If you're above it and you're close to this upper trend line, upper channel of the trend channel, upper trend line of the trend channel, you might have to be careful because you can move back to that middle line. Now, you don't know how. It could be very choppy like this, but still, you want to take profit at least and see if you can enter here again for that next up move. All right? So, this is very valuable stuff. I learned it from my Forex mentoring, Forex mentor, basically, and it's just great analysis you can do with a simple tool like this. You have these quarter lines, you have those spots here that you can use, and you have those percentages. So it's just great trading like that. Now sometimes you won't have a 4-hour direction, no problem. Just skip that currency if you want, and you go to a currency that does have a clear 4-hour trend channel like that. Alrighty. Now let me see if this is the correct chart. No, I skipped some. Right, okay, good. Now basically within that trend channel, for those of you who like added wave, basically it's nothing more and less than this is a wave 1, wave 2, wave 3, wave 4, wave 5. The wave 3 basically gives that thrust to expand the channel. The wave 2 gives that hook back for the angle of the channel. All right. The wave 4 could confirm it, for example. All right. The bigger wave 3 will expand it even more. The bigger wave 4 will confirm it again. The wave 2 confirms it again. So that's how the added wave fits within the trend channel. It's the added wave that gives this angle to the wave structure, gives the angle to the trend channel. Now what you want to note, by the way, is that although the trend channel is 45 degrees, preferably 30 to 45, within this trend channel you have less steep and more steep moves. The up move has a very high degree angle. Does everyone see that? It's like 60, 75. It has to be because the price is going to be impulsive. All right. The corrective is going to be like a very shallow angle normally, unless it's a more impulsive correction. Those angles are going to be less steep. It's going to be like 20. But in total, because this is 60 to the upside and this is 20, in total we get that 45-degree angle. Does everyone see that? Although the trend channel is 45-degree angles, with the trend trade is steeper and the corrective is shallower. And that's why we want to trade with the trend impulsively, because that's where we get that 60 to 70-degree angle, and that's why that trading is so much fun. All right? Because these are so steep and quick to take profits. That's why we like those areas. All right. Can you recall, James, what do you mean with that? Could you explain that to me? I don't know what you mean with that question. All right. So that's why those high degree angles within that trend channel are so cool. Now, if we put trend lines, and that's why trend lines are so important, single trend lines within this trend channel, because it's basically not, oh, can I repeat the explanation with regard to the angle? Well, basically the price, because it's moving impulsive, is going to have a very steep angle. And the corrective pattern is going to have basically less steep angle. It's going to be shallower. But because it bounces somewhere here, again, for another impulse, this price action angle is steep. This price action angle is shallow. This is steep. But if you then build a trend channel, it gives that 45-degree angle. So this is 60, this is 20, the price action within the trend channel, but the trend channel is then like a 45 to 30-degree angle. All right, that's what I mean. I hope that's clear. Let me know if I did it correctly for you, okay? So price action is steep. Yeah, got it? Okay. And that's why, now to continue, the single trend lines are so important, because although I have these quarters that are important, buying zones and take profit zones, and I know I have a percentage here as well, still it's not my most important method of trading. It's just the analysis, basically. The most important are still these single trend lines. Why? Because they are a great indication of, first of all, when does the trend change, but more importantly is they give an indication when the impulsive part of the price action to the upside here in this case is over. Because if this steeper single trend line gets broken, then the likelihood of that impulsive move coming to an end is high or higher. All right? So that's why it's important to see if price remains above that single trend line. If it breaks through, that's when we will probably want to get out of the trade, because it might be correcting itself deeper. And that's why also putting trend lines on top of the correction are important, because it could give a good indication of when the correctiveness ends. If it corrects like this, and you put a trend line above like that, and it breaks through it, then the currency could be ready for the next impulse. So that's why these trend lines are so important, because they give the indication when the impulse is over and when the correctiveness is over. When the impulse is over, we want to take our profit, basically. When the correctiveness is over, we want to either stay in the trade, or we want to add to the trade, or we want to take our first trade, whatever, you know what I mean. So that's why it's important. And you can see here just good examples of, getting out of the trade, getting into the trade. When we break this, we want to get into the trade, get out of the trade here, etc. Get into the trade, all right? And the fib ratios fit within that Elliott wave, within the trend lines, within the trend channel. Basically, we can expect a 618 fib here to give that angle, and a wave 2, we can expect a shallower retracement for wave 4, a deeper one for wave 2, and the targets as well here. All right, that's how fibs fit into this part. All right, so let's take a look at the charts now again to give you some real life examples. All righty. So we have our basically, oh, sorry about that, live charts, everyone, right now. Alrighty, so we got 5 waves. All right, so what do? We fib this up move, and we buy the 618. All right, we put our stop under this current low here. We get a head and shoulders pattern as well. We get an angle of our new trend. We got divergences, as I said already here. We got a break of that rising wedge. We're hooking back. We take a small risk here. Alrighty? We get the confirmation of the break of the trend and a hook back. We can actually take another setup right here and buy again the 618 fib. Once we break this triangle to the upside, we can move all risk to break even and actually move this trade to these bottoms and protect some profit. And we take profit at the targets. Alrighty? That's the strategy, guys. This is worth gold, believe me. You better be writing a lot of notes, or ask for a PowerPoint, because this is really, this is the best trading you can get, because it's great reward to risk. Alrighty? Look at, oh, excuse me here. Look at the targets here, right to the -27, right to the -618. That's where we're taking profit, or part profit at least. All right. You can definitely keep the trade on for even higher profits and trail stop the rest. Now, if we use our trend lines, single trend lines, you can see this was the end of the correction, right? This was a correction. Does everyone see that? So let me take off some lines here. Let me scroll forward so that these lines don't get, no, that's not good either. Let me quickly delete these lines, guys and girls, so that we don't overcrowd the chart. I want to, my aim is to keep the charts nice and visible, of course, so there's no issues with that. Alrighty, let's only keep those up lines. So, alrighty, we see these 2 hits. You got to be careful of this, because this was a false breakout here. So letting a 4-hour candle close is a wise idea, but that's where you get the confirmation. All right, of the break. Now I lost my train of thought. I wanted to say something. Yeah, I know what I want to say. Then you get the next trend line right here, like this, or like this. Alrighty. First breakout here again. This was a triangle. Alrighty. We build our channel. It's a bit different. Let's put it like, I can't see it. Let me zoom out just for a second. Yeah, like that. something like that, or like this at first, right? Let me do it like that, because this was still the new one we used, but we should actually go back to the old one. Hey, 1 second, I'm having technical problems with this fib already. Good. Alrighty. So, as I said, this new fib, then we can take another fib confirmation right here, and then we can fib even this breakout. Got another bounce here already, right to the minus 618 again. We can fib then this new swing high, swing low. This move up here, we get a 382 bounce. That's a bit difficult to take that fib personally, but you can see that if you maybe zoom into a longer time frame, like a 1 hour chart, you would need to reduce the risk there. But maybe, like for example here, this hook back, you can put your stop here, or that's something that's a bit trickier because the 382 is not really a good fib. The 618 is a lot better because of the reward to risk. So, that's something that you have to see yourself. But the initial 618s are always great fib buys there. All right. Then in any case, the single line trend lines work very well, as you can see. Another break here, another break here, and you get those continuations to the upside. All right. For example, you can even fib a move like this, and you get a 618 fib here, etc. Alrighty. Wait, we got a question here from James. So you mean we can just draw a trend line when that is high and low point? Not sure what you mean there, James. But you can draw, if we have a trend channel like this, you can take some swing highs, swing lows, all right, and draw your trend lines and wait for the breaks to the upside, okay? Because that's when you get the corrective part is finished. All right, for example, here was a good indication. We had a false breakout here, so you have to always be careful of that. But this one was a good breakout with some continuation. Here we got a breakout as well. Alrighty, let's see. And then you got this uptrend. You got smaller breakouts like here, here, this one, etc. All right, so that's how you can use trend lines for that. Wait, we got some questions here. Why the euro didn't go down today? Let's go to the current situation. The euro now is really in a very tricky situation because look at all these bottoms here. So yes, it could have made a small move down here, indeed. But maybe the market respected this level like this, maybe this way. There's a level here that it stopped right there. So from a technical point of view, that could be the answer. Which moving average? It's 250 on this chart. Exit the trades. James, you exit them at the target. So what I did was, for those of you, is that I added, if you go to fib properties, I do add. I click here add, and I click targets, minus 0272, minus 0618. Those are free targets. I paid a lot of money to get those targets, so, but that information is free for you. But those are good targets. I mean, those are really levels, key levels where market, I can give you tons and tons and tons and tons and tons and tons and tons of examples of where the currency just stops at a dime and pauses right at that target. Really amazing stuff, especially the minus 618. So that's where you want to at least exit part of the trade, minus 272, minus 618, minus 1,000, and trail stop the rest using whatever you want, moving average, highs and lows. All right. So those are very key levels. All right. Let's go back to the presentation. So you can see my point is that these lines indicate the end of the correctiveness and the start of the impulsiveness, or the end of the impulsiveness and the start of the correctiveness. Wave 2s are great fibs places, all right, and wave 4s are trickier. You can't buy, I don't buy the 382 fib because it's too big of a stop in my opinion, but what you could do is try to catch this break here, and then the stop is smaller, and the stop is like this big if you put it under the new bottom. All right, so that's how you can trade also this plan, use it using the edit wave as well, basically, if you use edit wave. So let's see, anything I missed? So we got the fibs, we got the trend lines and the trend channel, so you can see how you could fit all that together into a very nice strategy there. Sorry, the moving averages as well here, just to give an indication how they would react to that price level and how the MACD would respond. The MACD should respond by giving a new high here in wave 3 and wave 3, and it should give divergence at wave 5 already. The price actions should be impulsive in this up move. That's why this part is what we like to trade. It's the impulsive trending part. But sometimes, of course, you do have impulsive corrections like this ABC correction. This is a very corrective part. Sometimes you also get corrective with the trend moves, like wave 5. Wave 5 is with the trend, but it could be corrective. It could move very slowly to the upside. Although it's with the trend, it doesn't have to move fast. It could be very corrective as well. All right, so what we want to trade is impulsive trends and just maybe impulsive corrections, but it depends on which time frame you're looking at. If you're looking at a week chart and you're expecting an impulsive correction, well, that's probably going to be a trend on the 240 chart anyhow, so that's fine. Yeah, so the candlestick patterns, what we're basically looking for, another way of entering is if you see a candlestick pattern here at the bottom. That's one way of entering. One way of exiting is if you see an interesting candlestick pattern here at the tops to take profit. Same is true here. Alrighty. Then what we of course also want to look at is basically wedges, flags, triangles. Those are just all indications of what you can expect for a currency. Right? So if you, for example, see here like a flag, that's indication of continuation. What you're looking for, triangles, for example, here, this could be a triangle, continuation, etc., etc. Alrighty. Then there's going to be the risk management and trade management. That's important stuff. But we just have a quick question about recent swing highs and swing lows. We only have 12 minutes, so the time is very fast. You have to understand that I'm trying to actually teach something that probably requires 10 hours in 1 hour, to be honest. So you have to forgive me that some things I just can't fully explain. To be honest, it's really a 10-hour material what I'm doing in 1 hour. But just quick candlestick things. What I mean with candlestick is, for example, if we expect at the 618 a bounce and you see a candle 4-hour reversal candlestick like that, instead of taking it, you could take it at the 618 or wait for a candlestick like this and then take it upon the open and put your stop here to reduce your risk, for example. So that's a small risk. Then you have two trades going here and here. This is a good one. For example, this is a good one. Or you can even take the square up of this candle. You know what you feel comfortable with. Just to give you some ideas. This is engulfing 4-hour twins. Right? So that's how you can use price action in this strategy as well. So those of you who like candlestick formations and price action, you know, you can use your regular entries regarding price action, but once you have this knowledge, you have a better direction, you have a better feel where the currency could go to, So then you can filter which price action signals you really like and trade with those signals. So that should be a great optimizer for your price action signals there. Alrighty, so I have to leave it at that. Swing highs, swing lows. That's a good question. What you want to look at, well, what happened there? Press something, 1 second. Okay, good. Sorry, guys. Do we have our, let's see, is the chart back? I see that the chart is not fully visible. Is that true? Not sure. Does everyone see my chart fully, or is there some information on the side? You see a browser. Yeah, I thought so. I don't know what the browser is. That's the funny thing. One second, guys. I just need to figure this out. Why there's a browser. Because I don't see it. I just see that you see it. Ah. Let me close it quickly and open. Where's already? Let me just really quickly just closed it, and I'm now going to open it again. Ah, you're not seeing my current. Okay, now you should see my current screen. Yeah, good. Sorry, guys and girls. Okay, good. So let's quickly move on. Swing highs, swing lows. What you're looking for, and this is very key, very, very key. You do want to look for a preferably a full target hit, or at least relatively close. Now, to be honest, I wouldn't consider this a full hit. You really want to be a few pips away from that target. So what I would be looking for is this target. As long as this target doesn't get hit, I wouldn't be too keen on fibbing this. Now, eventually, if it stays in a triangle like this long, you could take smaller like setups at the trend line bounces with candlestick formations and anticipate the break, or wait for the triangle break here and then go to the upside. But a fib of this I wouldn't do until we really reach the target, because what I'm looking for is really a strength of the currency to go to the target. Once we do that, then I'll be looking to make the next fib. So that's what I'm looking for. Now, regarding these swing highs, I'm looking for example, 5 waves to fib this entire move. Or if I have a wave 1, 2, I would fib this move up, for example. So I'm using basically added wave for the fibbing, but also just swing highs, swing lows like this. All right, you could use the fractals even for that. Once we do have 5 waves, though, then I'm fibbing the whole 5 wave up. All right, fractals could help in that regard too. Now I'm going to quickly go into this risk and money management, because that's very interesting and important stuff as well. And if I were you, grab a quick piece of paper, because this is good stuff. I got a question about my origin. Now, I'm actually Dutch, but my dad is Czech, so I have a Czech surname in that regard. Indeed, that's true. Yes, that's it. That's it. So I'm half Czech in that regard. Yep. But I did live most of my life in Holland, and I have a Dutch passport. But yeah, I'm half Czech. So this is the risk management. I think, did I skip some? No. Alrighty. So what you want to do is basically you want to take a small risk here at wave 2. And what you want to do is wait for the break of the wave 1 and then start adding here on smaller time frames so that you kind of add with the wave 3 of 3 here. And you have this one going from a wave 2. This one is, of course, still the most riskiest because you're still in a downtrend. Although we have divergence and a head and shoulders pattern, this is the most riskiest, so you want to take the less risk there, maybe 30%. If you have a candlestick reversal pattern, maybe you can add another 20 or 30. or 25, 25. Then you want to add here a bit. Then you have already profit going here, or at least maybe break even. You can add some of that risk right here, and you want to take profit there. Then you want to leave some risk on. You don't want to take all the profit here. You want to leave some, take some profit at the end of wave 3, but you want to leave some risk on for the bottom, for the continuation of wave 5. All right, so take some profit at wave 3 of 3, leave some for the wave 5 of 3. So maybe close 70% here and leave 30% for this, and then close everything here. Then you want to wait for the bigger wave 2 and then do the same process basically. Take some risk here, close most here, leave, for example, 1/3 on for the bigger wave 3, but close 2/3 here. Then add another part here, add another part here when we break the top of wave 1. All right. So this is an ideal. Don't take any risk in the counter trend corrective moves. All right. Now applying this is a whole different art, and is a lot more difficult. But at least you're aware of this theoretical knowledge, so that you can at least try to apply and use more risk at levels that are maybe more appropriate, and you can vary your risk in that regard according to the currency setup. So I'm not saying practice this at first because it's really difficult, but at least you're aware of how you can adjust your position risk accordingly. All right, so you at least have that idea. Maybe we should do an entire webinar on that, because it's just going to be way too complicated now within 4 minutes to do that. But at least you have a basic idea. All right, cool. I see that Antanasia is living near the Czech border. Is it close to Hradec Králové? By any chance? I have family there actually. Or is it more close to Liberec? No, okay. Ostrava, okay, a bit further there. All right, so maybe close to Krakow. Krakow, right? Beautiful city. Yes, that's a really beautiful city. I was there a few years ago. So basically, this is the money and trade management, what I was talking about. So, you know, there's two things. What you want to risk, basically. So you want to risk maybe if your max risk is 1%, take 0.3 here, 0.3 here, 0.3 here, and then, you know, or 0.5 here, and then here a full percent, for example, here. Then, of course, then there's the money and trade management, where you want to move to break even and stuff like that, where you want to enter and trail stop. That's going to be very difficult. We're going to actually have a money management course or webinar with Admiral Markets next month in April. It's already scheduled because I anticipated that this would be a bit tough to fit within an hour, kind of mission possible, but I wanted to make you aware of that. What you're looking for, as I said already, is wave 1s are going to be deep. All right. Let's see. Where you want to move to break even, for example, is if you break this top and you're going into wave 3, and within wave 3 you already made 1, 2, and you break again, you can easily then move the current trading, the current trade, excuse me, to, for example, this bottom, or even this bottom, because then we're in a wave 3 and we expect impulsiveness. It should keep on going. So if we're in wave 3, we want to keep the, we should see the trade keeping its momentum, let me say it this way. All right, so you can use, for example, the top of wave 1 as a place to hide your stop as well, and stuff like that. All right, so that will be just next time, because I will go more in detail as well. Alrighty. So we are exactly 1 minute left. Let's see, can the next webinar start earlier than this time? Well, the problem is that we've scheduled this time, unfortunately. So I'm going to see, I guess, with together with Admiral Markets if there are, good participation levels here, but that was decided by them. I didn't choose it myself, to be honest. So if you want to change it, best is to write an email to them, because I don't have influence on that. I just agreed with this time, basically. Very simply put. So I hope that I transferred some useful stuff there. One way of looking at the markets, you can use it even if you use pivot points, even if you use price action, even if you trade patterns. You can use trend channels, single trend lines, fibs, and maybe added waves. I know that it's not a popular tool, so that's subjective. Whatever you want, but at least trend channels, single trend lines, and fibs. You can see together with price action how you can really get good trades with good reward to risk. If you use also candlestick formations for your stop loss. If you can identify the trend and trade with that trend, you just got really great trades there. All right. So I hope that you enjoyed it. Sorry if it was a bit fast. It's just, I was trying to put all that stuff, 10 hours worth in 1 hour. So it's a bit ambitious of myself. But, practice it. If you have any questions, just let me know. Most of you have my email address by now, I guess. And practice it, because it is difficult. And don't be afraid not to trade a currency, because sometimes really the currency is just not set up maybe appropriately. There's no trend. So there's nothing wrong with staying out of a currency, all right? But if you can see a good trend building up, especially after you have divergence, then you can use these methods. Alrighty? All right. Where someone's asking where you can get the webinar as PDF. Yes, it's a lot of information. Alrighty. If you don't mind sending me an email, then I will send it to you. Let me quickly write that down, folks. Alrighty. So send it to there. It's great stuff, because I paid quite a good price of money to get this information, and Admiral Markets is providing that for free to you. So I hope you really appreciated these items. Alrighty, I'm glad that Tunisia likes it. I thank you actually for being here, because I appreciate your time as well. That's great that you had the time to be here a full hour. So with that said, I wish you good trading. I wish you a good weekend. I'm looking forward to see you next week. We're going to be looking at actually intraday short-term trading on the pound dollar for those of you who like action and within the day trading. Make sure to watch that. That's next week, Thursday. And I hope to see you then. And goodbye, everyone. Talk to you soon. Cheers.
The organizer